Today's episode is brought to you by Treston Associates. Treston Associates provides a growing suite of back-office services to mortgage brokers. One of their most popular services is mortgage fulfillment. Treston Associates will handle the fulfillment of your files on a per-file basis. No monthly fees and no commitments. You have a team of experienced professionals working for you without the headache and expenses of payroll, training, and turnover. Get in touch with Treston Associates today by visiting their website, tresstonassociates.ca, and book a call for a fee evaluation of your business. You can also click on the link in the description. Treston Associates is helping mortgage brokers scale their business. Contact Treston Associates today. Welcome to another episode of Real Estate Tribe. We're your hosts, Harris and Umar Zulkarnain. Welcome.
Welcome.
How's everything going with you?
Good. What about yourself?
It's going all right. Another week, another plethora of sensational headlines.
Developments, contradicting headlines too, I see.
Yeah. It's all over the place. I feel like, I don't know. It seems like the only thing I see is doom and gloom. Or extremes. Either everything is just going to be perfectly fine, or everything is crashing and burning, and nothing that really kind of it gives you a pragmatic approach or a good understanding of where the market's at. So that's it's interesting. You have to really dig through everything, understand everything, and this is incredibly important for mortgage professionals because mortgage, real estate, whether you're a realtor or a mortgage broker, to be able to understand the market correctly is one thing. Then also understanding the type of sentiment that's in the market so that you can actually translate real information or information that you have kind of concluded to your clients or potential clients in a way that's palpable and for them to kind of really understand what's really happening and perhaps why they're reading what they're reading.
Definitely. I think it's about also considering where the information is coming from and then understanding that there's obviously some interpretation going on or some certain, when you have data that's pushed out or emphasized, who is emphasizing that data matters too, because then that helps you better understand that data and maybe interpret it in a different way.
Yeah, and then we also, as much as there is a bias that we read in the newspapers, we should also kind of take a look at our own biases. So I see professionals, and the top tip today actually for realtors and mortgage brokers is planning, and we're going to get to that at the end. But my biggest thing is looking at your own bias, and I see a lot of professionals who sometimes don't want to think that something bad is happening in the market, so they ignore it completely. Or others who feel like there's nothing but bad happening in the market, and so they're just running scared and making decisions that aren't the best. And the best thing is to kind of really understand who you are, have that conversation with yourself, have that ongoing conversation, and kind of delving into who you are. So you maintain and develop a sense of some kind of element of self-awareness, so that when you're reading through things, you're actually kind of trying to figure out what the truth is as opposed to how are things making you feel. So.
Yeah, no, I think that was very well said. I think one of the kind of practical ways that in the mortgage business or any business generally that plays out is when there's a loss of business or there's a reduction in volume. One of the knee-jerk reactions is usually, if it's significant enough, especially, that it's not something that you did or didn't do. It's the market. The market's going. It's spiraling downward, and that could be the case. But at the same time, you have to really be introspective, look at your business, look at your processes. There's other things going on too. Maybe there's other variables where the market is kind of changing, and maybe you haven't changed your business in the same ways.
Yeah.
Right. So
yeah, I mean, the market could be doing whatever it's doing, but there's always room for improvement. With professionals, I have never come across ever the perfect business. And so the point is, this kind of pushes, I feel like when there's a lot of business coming in, obviously you're going to be focusing in on your clients and perhaps You're not, your processes aren't the best. Perhaps your branding isn't the best. Perhaps your marketing isn't the best. Perhaps your accounting isn't the best. Perhaps the training of your professionals isn't the best, but you're trying to get those files completed, and that is good. That's what you should have. But now's the time to refine. And so when you do see you have some slack, that's when you start refining those processes. So on the next turn and with the next mountain of real estate deals coming through across your desk, your firm is better prepared to handle them in a way where people don't forget who you are.
Certainly.
Yes. So one of the first things that I wanted to talk about is from BMO. BMO, like, seriously, they like to, like, there's a lot of just, I found two banks, and I'm not saying that they're wrong. BMO and RBC both are very much on a lot of doom and gloom. So BMO had an article where it's saying that, again, Canadian real estate market has entered the bear territory and they expect it to get worse. What they're basically, like, the article goes through something. It says that the adjusted inventory for homes reached 3.4 months in July, and that's up from 3.1 months in June, and it's almost twice the 1.7 months at the start of the year. So it's growing. And that does, it sounds significant, but again, my knee-jerk reaction is always, well, you know what? Beginning of this year or last year, everybody was used to like 1% interest rates, and going back to 3 or 4 or 5 is not abnormal. It was pre-COVID. That's where we were at. So I would like to think that perhaps 3.4 to 3.1 is the average time it takes to sell a home. I do think that the last year was unreasonable. So I'm not completely alarmed, but if you want to make those adjustments and say, oh my God, it's crazy, sure, go ahead. They also had a new, way to kind of figure out whether it's a buyer or seller's market. And I'm pretty sure all the realtors listening know this already, but perhaps the mortgage brokers don't, perhaps the real estate lawyers don't, perhaps anybody else in the market, they may not. But there's a ratio called sales to new listings ratio that is used to see if it's a buyer or seller's market. And basically, sales to new listings is self-explanatory. So in a given period, how many new houses were put on the market versus how many houses were sold. And if you're around the 50% market, so you're basically in a balanced environment. Whereas if the ratio rises above 60, it's considered a seller's market. And if it's below 40, then it's a buyer's market. And we're right around 50%. So we're kind of balancing, but arguably we're told that it is getting perhaps worse. Now, here's the other thing, though. It's saying it's getting worse, right? Mm-hmm. But I was having a conversation with one of our, on our law firm side, one of our referral partners, and they were saying that, you know what, like business is slowing down, right? And we had a good conversation around it, and they were like, you know what, last year it wasn't like this, and this year it is. And I'm like, well, we're also kind of maybe slowly moving back to, just as like the rates are normalizing, perhaps the if the buyer seller market is a bit more balanced, if houses are on the market for a reasonable period of time, and a weekend is not reasonable enough for people to come view your house, to put in an offer with a financing condition, with a home inspection condition. Perhaps we're also moving back towards seasonality, right? And that with this ratio of sales to new listings, I'm assuming it's not going to stay the same throughout the year, that it's going to have some changes. Naturally, people may not be buying as much as they normally do. I know in a normal market, end of August, you know, you're going off on vacation with your family because it's like the last few weeks before kids got to go back to school. A lot of people, if you don't have kids, you want to get out because it's the summertime.
You don't want to move right before kids start school too.
Yeah, that's a huge thing.
That headache.
Yeah, so like typically the for what I had seen, the highest kind of sales peaks were May, June, July, August. All right? That's where it was kind of like those 4 months for purchase and sales was in a traditional market. Something that was crazy. Like last year, we were just seeing spikes all over the place. I mean, even this year in January, we were fairly busy. And usually January, you're just listening to the crickets, right? Like you get some business in, but it's nowhere near as much. But January, we had a spike. And then because the interest rates kind of were going up, I feel like you had people stop, but then it dipped kind of exceptionally. I feel like, maybe moving more towards a normal like seasonality where people are not going to be buying now. Perhaps the refinances again are going to pick up in the fall. Like there's different kind of areas where you have naturally the summer time is the best time. Spring and summer is the best time for Canadians to buy and sell a home, to renovate your home, to do a lot of things, to whether you want to move, whether you want to buy a second home, there's a lot. And then in the fall, you're moving more towards refinances, a lot of that. So that's the normal market. So if it's slowing down, it does not necessarily mean it's something that is bad. Perhaps we're just moving more towards a normal market.
Yeah, no, definitely. That makes sense. I think also it also doesn't mean that there's other changes coming up that could reverse course and we move away from a normal market again towards a more of a bull market as well. There was an article I read the other day. It was one from an analyst from one of the big banks saying that Bank of Canada is going to reverse course within the next few months. That was a prediction. Then realtors, I saw a bunch of tweets and TikToks about this article where realtors were saying, buy now because prices are about to go back up. Right. So anything's possible at this point.
I mean, I definitely think I see that happening. I feel like the Federal Reserve, and here's the other thing, and I say this often enough, anybody who knows me knows this, the Bank of Canada rates are not determined in a vacuum. They're not determined in the Canadian bubble. They are very much considered at a global level, at a G7 level, and more specifically, we're very coordinated with the states. If we bump our interest rates up, or if there's a strong differential between Canadian interest rates versus American interest rates, right? Let's say we're higher, they're lower, right? And there's a good enough differential. Our dollar is going to get stronger. And as it gets stronger, our exports are going to go down, and that really slows down the economy.
And where are all of our exports going?
Yeah, so 80% is with the States, last time I checked. So great majority of everything is going to the States, which is why we have to maintain that currency. I don't necessarily think the States are going to keep going up. There's a lot of issues happening down south. One of the biggest things is we've got elections coming up. I do feel like the Republicans are going to do a clean sweep here, which is going to put more pressure on Democrats because in 2024 is when the presidential elections are. And I do feel prior to then they're going to start easing up on the market, start putting money in people's hands so that sentiment changes, because they've been saying that inflation was transitory for over a year, and now it's safe to say that it's not, and it's kind of coming out to the forefront, and everybody kind of sees that it wasn't. I mean, why you would think that you've printed so much money, you did so much quantitative easing, and inflation's only going to be transitory is a different story. But definitely, I feel like they're going to be easing. Once they start easing, we're definitely going to be easing. And as soon as we ease, the market's going to change. And here's the other thing, and I repeat this enough. Market in the States is very different than ours. We have a strong labor market, and we have a shortage of housing. The only thing that's really preventing people from buying is qualification, A, and B, just a fear, right? It's not like we have too many houses and people have too many choices. That's not the case. We still have a shortage. I think Toronto Star actually had recently a article. I think that Ontario's population was going to increase by 30% in the next few years.
Oh, wow.
So there's the shortage is there, and that shortage, the long term problems that we have, they don't go away by increasing the interest rates because people still need a home. Because then you see like rents spiking like they are right now because people have to have some place to live, and those laws that need to change to make sure that housing becomes a bit more reasonable. They're going to take some time to change if they do change, and I don't think anybody's really making a meaningful change. I know that there was like certain kind of calls, and Trudeau said that they're increasing foreign. I think it was speculation tax if foreigners want to buy from 15 to 20%. There's not that much. That doesn't really affect much. There's ways around it. There's very few people who are coming out of nowhere investing in Canada. That does not work.
I think that's just politics. So I think
Yeah.
it's more kind of saying that, look, we're committed to the people that live here, to the Canadians, and this is maybe trying to identify a problem where it doesn't exist, right? Where the problem is not a lot of people from abroad investing. There is immigration, but if anything, the immigration, the true immigration, the people moving here and buying houses, that's helping the economy.
Yeah.
That's driving demand for the Canadian dollar. That's filling
But,
jobs.
but those people, I would argue that are foreigners buying. They have a connection to Canada. If you have enough money to go buy $1 million home, and you don't even know the country, you don't have a connection, you don't have immigration, what are you doing? Are you buying it directly? You're not buying it directly. You're going through an investment vehicle, and that investment vehicle more or less is going to be Canadian, and that tax doesn't affect them that much. But for everybody else, it's naive to think that's going to have a real impact. The reality of things is Canadians need more housing, not foreign investors need more housing. The appetite's not that big to begin with, so that's not going to go away. So as soon as the interest rates drop, you're going to see that demand again as people kind of try to jump in and get into the market as quickly as possible.
Yeah. No, and so on the other end of the spectrum, though, then okay, interest rates are dropping, but what about inflation? There's a interesting headline: Canada's inflation revisions show something is, quote, really wrong. National Bank. So there has been 3 revisions done so far. The core inflation came in at the highest in over 32 years at 5.3%.
Wow.
And it's increasing. And as a lot of people know, the basket of goods used to calculate this inflation has changed over time, over the years. So the true rate of inflation is much higher. And what tools are available if, let's say, Bank of Canada reverses course out of necessity? They would only do this out of necessity. They wouldn't do this because they have an option. Because I think if they had a choice in an absolute sense, then they would increase interest rates to temper inflation.
Yeah.
But the necessity would be that then that means that we have a recession coming, or we're in a recession, or we're going deeper into one. What do you think about that?
No, I mean, I feel like the rate increases have been purely a political move. Okay, since the 80s, the way inflation has been calculated has changed, and the rule of thumb is whatever your core inflation is, you double it to see how it was calculated in the 80s. So that's how much it would have been in the 80s. And so definitely to control that inflation, you do need, think of it this way. If your buying power is losing value of 5% every year, why wouldn't your interest rate cover the 5%? Right? Then you need your own margin. Then there's a risk involved, right? And so then at the end, you're looking at like a 8, 9, 10% interest rate, right?
Or more, I would say.
Yeah.
If you're saying double is 10, right?
So I mean, okay, so 5% inflation. According to the 80s, it's 10%, right?
Okay.
If it's 10%, you'd want some margin. Margin is, or you want some margin for your risk, right? You want the risk profile and a return, right? So off that 10%, because inflation is so high, the risk is higher to put your money on the line here. So you'd want a higher margin too. So why wouldn't you want 15, 18%? That's where the interest rates should be. Mm-hmm. Realistically, they should be at 18% right now. They should be at 18%. Exactly what was done in the 80s, right?
Yeah.
But because we've gotten addicted to debt because of all these other things, right? It's we're not having it. We're keeping it at, where is it right now?
Core inflation, or
The interest
5.3%. What is it at, the 2.5?
Yeah, something like that, right?
Yeah.
That's like nothing. That's a joke.
Yeah.
That is a joke. When people are like, "Oh my God, we're at like," I'm like, "That's a joke, man." It's like a 1% bump is a joke. Your housing prices at 3% is a joke. Now I understand there's other concerns when people are looking at it and they've got like a variable mortgage and they're paying. They're like, "Oh my God, the interest rates and whatever." There's all this other stuff involved. 100%. I understand the worry behind it. I understand that, yeah, you won't be able to pay. I'm talking about this from a purely economic perspective and not one that's political, not one that is want driven, not one that's a result of what have Canadians bought, but rather from a purely economic perspective, interest rates should be at 18% right now.
Okay, but practically speaking, so 18% would drive down inflation and would be the ideal number. Let's assume, but obviously, that would assume that our ideal is that there's no inflation. But in reality, there's always inflation. So there's going to be deterioration in buying power, and we're at a state in the economy where that's going to happen regardless. There's no scenario where that wouldn't happen.
There's no current scenario.
Yeah. So then the situation, even I would argue, even in the 70s, when they hiked up interest rates to whatever 18-20%, they were looking at two different things. They were considering that we need to temper inflation, but at the same time, they understood that the economy generally had to stop. People had to stop buying as many luxury goods, you could say, right?
Yeah.
So it was considering both factors, that we'll go through a period of people buying less, and then we'll also go through this reduce the money supply, and then eventually we'll end up in a better place. So I guess my point is that the goal is not just, okay, let's make stuff cost the same as it did last year. It's let's create an economy where we're chasing less luxury goods, focusing on trying to make sure people are getting the fundamentals. That should be the real goal. And then tempering inflation.
I mean, it's not just luxury goods. It's just we're going less after wants.
Yeah, which I guess it's how you define luxury goods, right? It's like, do I need 3 TVs, or do I even need 1 TV? I mean, nowadays everybody says they would. But
do you need 10 pairs of pants, right?
Yeah.
People used to survive off of one pair of shirt, like one shirt and a pair of pants, right?
Yeah.
So, and if you speak to somebody like that, I think myself included, you'd be like, oh my God, what the heck? That's like so alien. But that's the reality. Do you need all those pants that you just kind of stick around and then you toss away later on or whatever it is, right? So or do you really want to use them and then that's it because it's just an article of clothing? So now we're in a kind of mindset of just accumulating all this material stuff. And one of the biggest actually signs of that is you'll see so many storage facilities going up everywhere.
Yeah.
Right. Like those companies are just making a killing because everybody's got so much stuff that they don't want to get rid of it and they don't got the real estate to keep it. And so they're renting like small units to go put all that stuff away. That kind of shows that perhaps we're consuming a little bit too much, more than necessary. And to stop that, it's like, you know what, like, yeah, sure, it feels painful, man. I'm going to the mall, I'm not buying anything, but you didn't need it to begin with. So perhaps it's not a bad thing.
Yeah, no. But then on the other end, so I mean, I think that problem is, I'm not 100% certain about this, but I think that problem is more our generation or millennials that are more geared towards hoarding things. Or not hoarding, buying lots of things.
I think it's a human just element where you can give people, for most people, as much as you can, and they'll still want more. I think there's a definite element of that. And in prior generations, you didn't have that.
Yeah, so it's because of circumstance that people who grew up, let's say 90s, 80s, even. I think when was the mall became a thing, was it 80s, 70s, something like that.
No idea.
And that's when people started buying, and then it became you can buy a shirt for $5, a pair of jeans for $10. Prices became ridiculously low, and people get hoarding more and more.
No, but I'm speaking of that. Sorry, not to cut you off. I just find like if you really go into a mall, right, it's one of the biggest miracles there is. Because if you think about it, right, our generation, previous generations, they just grew up with some place you go. But in reality, if you go back 50, 100 years ago, right, to find something to get whatever was difficult. A mall is something that is climate controlled, it's just right, perfect temperature. You go in, you have so many vendors that are giving you so many things. It's a very miraculous kind of creation or development that like you got every single toy there, you got every single type of clothes, big people, small people, you know, like every single color, pattern, whatever the heck you want, right? And you can buy as much of it as you can, you know? And when I say as much of it, because it's cheap, right? So it's not like you're going there once a year to pick out your Sunday best outfit, right? It's more like you're going there every weekend to figure out, you know what, can I grab something? Can I grab a pair of pants on my way home? Like that's a crazy kind of mindset.
Yeah.
You know? And it shows where our society is going or has gone. Instead of saying, you know what, can I read a book by the end of the week? It's more like, can I grab these pair of pants on my way home? That's weird. And then one other thing, and I know I'm going on a rant. That like what really got me thinking of it is, you know, the path under like Toronto.
Yeah.
They got full of markets. Like it's full of markets
Stores
and stores and people selling all sorts of stuff, right? Clothes, whatever it is. And I'm thinking like, would I personally want to come down here and like travel to Toronto to buy something from one of these stores? No, I'm not the target market. If I go downtown, right, I'm going to go to the Eaton Center. Who are those markets for? It's for people literally grabbing something on the way home.
And seeing them every day walking home.
Yeah. Yeah. So they see it every day. Eventually they like something. And then they go buy it on the way home. Pair of pants, shirt, whatever it is, right? It's not necessarily a decision that is a need-based decision. It is a want, right place, right time, and I'm going to get it. So all those things have to change.
Convenience focus. But to your point too, it's funny. Like I think last week I was at Yorkdale and I don't know why. I just noticed how massively high the ceilings were.
Yeah.
So high that you don't even feel like you're inside, but you're inside.
Yeah.
Like that's how crazy it was. The how they built out these structures so that it's like you're shopping outside, but it's climate controlled, but you don't feel like you're inside. You don't feel congested. You feel like you're in an open environment. It's a massive feat.
It's a very glamorous, focused structures that when you go in, you feel like, oh my God, I just want to buy, you know, I just feel good. The sensor there, everything. It's like, it's really the epitome of the marketplace. Like all those stuff, like interesting when you watch movies, right? Of like any kind of movie that's set like 100, 200 years ago, and you have like vendors on side streets and all that stuff. You know what I mean? I'm talking about even like Disney's Aladdin. You see how like in the beginning, I don't know why I'm thinking of this, right? But there's a marketplace. There's vendors there. Same thing happens in all across the world. It's not specifically to the Arabia. It's like in Europe. It's in North America, South America. Wherever you go, there were these markets, and the markets were meant, you know, they're meant to get you to buy. This is just the market with steroids. That's what it is. They refined it, and they just got it down to just the perfect buy mentality, which is it's completely off topic. But so inflation, going back to inflation and curbing demand, perhaps we don't need all of those things, right?
Yeah, but I think there's always I want to bring this up, like we don't have to go into it into depth. There's always kind of diverse opinions and experiences too. So while we're talking about how there's a lot of people that are consuming a lot, and ourselves included, there is that idea of a buy more, and you have 5 closets with tons of clothes in them, and maybe the next few years there'll be less of that overall. There's still a segment of the population that is being more impacted by the inflation that is not within that segment of overconsumption too, right? So I think they're the most impacted by the circumstance, because they're living paycheck to paycheck, and now they can't afford those necessities either.
Yeah. So. I mean, unfortunately, that's what it kind of boils down to, because a lot of people refinance their house, started buying stuff, you know, if you had the means to. And then on the flip side, there are people who genuinely need homes. They would love to get into a home. They'd like to buy a home. They'd like to be able to pay it off. A lot of prudent investors, prudent Canadians, that because of this current situation are unable to enter the market. But I do feel like as soon as the market flips, they're jumping back in if they can.
True. Okay, so what's I guess our top tip for today?
Top tip was planning. I'm saying this because I had a really, really long conversation again with a referral partner the other day, and one of the biggest things that we talked about was basically, interestingly enough, a lot of real estate professionals, whether you're a realtor or a mortgage broker, they're complaining, right? Rightfully so. Volume's gone down. There's a lot. I mean, even real estate lawyers. There's a lot of different professionals that are being affected by the market. Transactions drop 50%. It's not like people are going to be untouched. That's a decent amount of movement. But the complaint was basically that, you know what, people are basically looking at this pricing as like they're doing kind of day trading, right? And that because interest rates went up, price went down, everybody's kind of frozen, when in reality, they should be looking at a more long-term investment, right? And my kind of quote to that is always, basically the Warren Buffett quote where it says, hey, if you guaranteed me a recession next year, I would still be buying and selling the same stocks I am today. Meaning that you're buying for like long-term reasons. You're buying for good fundamentals, right? The same thing for housing. If you're buying for it to like increase value in the next 3 months, then that's a different story. But if you're buying and you're not going to be happy, but if you're buying to live in a house, you're not going to be leaving quickly. 5 to 10 years is not like, and by that time it's going to turn around. If you're buying to increase your quality of life, if you're buying for several different things, then yeah, definitely those fundamentals are still there. So if you could, you'd stretch yourself to buy a house, and I would completely agree with that. When I say stretch, I don't mean putting everything on the line, but just being stronger in terms of I might buy this, it might go down value the next month or two, but it's coming back up. And so I had a good conversation about how, most of the people are kind of freaking out and they've stopped, but then most real estate professionals are doing the same thing with their business. The same people who are complaining about real estate markets are doing the same thing with their business, right? Most mortgage professionals, most real estate professionals are only thinking about, oh my God, by the end of this year, how many transactions am I going to be closing, right? And am I going to be able to go on that vacation? Am I going to be able to buy this stuff, buy that, whatever it is, right? And when in reality, you should be thinking of it this way. If you feel like, you know what, your clients aren't thinking about the value appreciation in the next 5-10 years, are you thinking about the business in the next 5-10 years? It's not like real estate's going away. It's not like people don't need homes. It's not like where we are right now is where we're going to stay forever. We're in a phase of the market, and it's been very short. It's been like a few months. It's like less than nothing, right? And if you're shook, like, because you're seeing your own business as if you're day trading, that's not the best place to be. And so the top tip is to start planning. Don't plan for the next year. You don't plan for how does 2023 look like. Plan for how does 2032 look like, okay? That's a good plan to begin with, and see where it's going to be, what you need to build out. If you have free time, you know what's a great time? What's an amazing thing to start? Perhaps you want to start developing procedures in your firm, procedures with yourself. Perhaps you want to start drafting and developing content, right? So that when you do have the excesses coming in, when the deals start piling up, you have enough content to be sending out to keep people engaged. Even now, you should be producing content to keep people engaged. But what are you doing to plan for the next 10 years? You should be figuring all of that out now. Now's a great time.
Hello? Oh, there we go. I completely agree. I think from a practical standpoint, if you look at whether you're a single broker, you have a team, whatever your particular situation is, there are a number of functions that you have to be handling when you're running a mortgage business, whether it's the fulfillment of mortgages, underwriting, sales, marketing, leading the company. And ideally, if you're doing everything right, then everything is coming together as one fully functioning machine. And that's what you're planning to build, right? So there is a vision that you have to have, that I have all these pieces, whether it's me alone or I have an assistant or I have 5 assistants or I have a team of 100. Everything is working together in this kind of perfect way, or not necessarily perfect, but as a machine, and it's running itself almost. And that's the vision. And as Jeff Bezos said, you have to be stubborn on the vision and flexible on the details. So you plan the details to get to that vision. And maybe some of those plans won't work out and some of them will, but it's always looking at that plan, reviewing that plan, evolving that plan, and evaluating it continuously to be able to improve your business.
Oh, well said. Thanks for joining us today, guys.
Thank you, guys.
Take care. Today's episode is brought to you by Tretson Associates. Tretson Associates provides a growing suite of back office services to mortgage brokers. One of their most popular services is mortgage fulfillment. Tretson Associates will handle the fulfillment of your files on a per file basis. No monthly fees and no commitments. You have a team of experienced professionals working for you without the headache and expenses of payroll, training, and turnover. Get in touch with Tretson Associates today by visiting their website, tretsonassociates.ca, and book a call for a free evaluation of your business. You can also click on the link in the description. Tretson Associates is helping mortgage brokers scale their business. Contact Tretson Associates today.